Hi, this is Chuck Hughes. In today's video, we're going to take a look at real estate investment trusts. A real estate investment trust is a special type of corporation that does not have to pay federal income tax if the real estate investment trust distributes at least 90% of its income in the form of dividends to its shareholders. So this special tax treatment allows real estate investment trusts to pay much bigger dividends than other standard dividend paying stocks because they pay no tax. And we'll see an example of the return potential of real estate investment trusts with this special tax treatment. And there's generally two major categories of REITs. The first category would be equity REITs, and they own physical properties such as retail shopping centers or apartment buildings. And the second category of REITs would be mortgage REITs, and they invest in mortgages. The REIT strategy is fairly simple. We want to buy REITs that have a history of raising their dividends, and number two, we want to reinvest those dividends in additional shares to compound our returns. And I'll show you an example of compounding by reinvesting dividends here shortly. And I found that the REITs that have a history of raising their dividends are generally performing well, and that enables them to consistently raise their dividends. So that's a good way of selecting a real estate investment trust. As I mentioned, real estate investment trusts pay no taxes, so this gives them a huge advantage in paying out dividends over other typical dividend-paying stocks. And as a result, real estate investment trusts as a whole have been beating the general market for many, many years. And I'm going to take a look at 5 different types of real estate investment trusts that invest in different types of properties, and we'll compare their returns versus the S&P 500 index over the past 10 years. And this sampling of 5 different types of REITs produced an average return of 817% over the past 10 years versus 9% for the S&P 500 index. So you can see that these REITs obviously way outperformed the general stock market. In our first example, we're comparing the returns of Tanger Factory Outlet Centers Real Estate Investment Trust to the S&P 500 index. And Tanger Factory Outlet Centers acquires, develops, owns, and operates factory outlet centers. And Tanger over the past 10 years has had a total return of 807% versus 9% for the S&P 500 index over the same period. Our next example is for LTC Properties, which owns long-term care and assisted living facilities. And we can see from the profit graph that LTC Properties has produced a 1,278% return versus 9% for the S&P 500 index over the past 10 years. So again, this demonstrates the ability of REITs to outperform the general market. Our next example is Mid-America Apartment Communities, which owns and operates apartment buildings. And Mid-America has had a 460% return versus 9% for the S&P 500 index over the past 10 years. Federal Realty Trust owns and manages shopping centers, and Federal Realty's had a 608% return versus 9% for the S&P 500 index. Our last example is for national health investors, which finances healthcare properties. And National Health has had a 933% return versus 9% for the S&P 500 index. So I think these examples of real estate investment trusts gives you a good idea of how they can outperform the general market. I like to reinvest dividends in additional shares of stock, which allows me to compound my returns. And I'm displaying a brokerage confirmation that shows I bought 4,000 shares of American Capital at $28.56 for a total cost of $114,248 after commission. American Capital is a mortgage real estate investment trust that invests in government-backed mortgages. And American Capital is currently paying a quarterly dividend of $1.40 a share. And the $5.60 share annual dividend provides a 19.6% yield on my $28.56 share purchase. Now, American Capital has raised its annual dividend 166% over the past 3 years, which was a signal that the company was growing its profits and has a very successful business model. So let's take a look next at compounding my returns by investing the dividends in additional shares of stock. Now this table displays the returns for reinvesting dividends in my share purchase of American Capital. And although American Capital has gone up in price since my purchase, this table assumes that the stock price remains the same and the dividend remains the same. And based on those assumptions, if you had reinvested dividends, my $114,000 investment grows to over $774,000 after 10 years. And this table summarizes the returns for compounding your returns, assuming no change in the stock price or the dividend. And we can see that I would achieve 100% return in less than 4 years and a 200% return in less than 6 years. And if we look at the annual yield table, after 3 years I'd have a 31% yield. After 5 years I'd have a 45% yield. After 10 years I have a 118% annual yield. So this shows you the power of compounding dividends. Now I make trade recommendations for real estate investment trusts through my Inner Circle advisory service. And if you'd like updated profit results for the various Inner Circle portfolios, just log on to chuckhughesic.com and click the trade results link. This is Chuck Hughes. I want to thank you for listening, and I wish you the best in investing success.